Welcome to the Real Sense Podcast, where we bring you bite-sized advice to help you make real sense of money, the markets, and helping you create a legacy for you and your family. Wherever you may be, however you may be listening, thank you for making us a part of your day. In this episode, we're going to talk about risk, what it is, how it works, helping you to differentiate what type of risk tolerance you may have towards investing, and bringing this all together to help you move further along in your investing journey. I'm your host, Isaiah Riel, financial advisor with Laguna Wealth Advisors. So in this episode, we're going to get right down to it. So risk, according to Investopedia.com, is defined as the chance an investment's actual return will differ from the expected return. Risk includes the possibility of losing some or all of your original investment. So a fundamental idea in finance is the relationship between risk and return. You may have heard of it. The greater amount of risk an investor is willing to take, the greater potential for a return. So an example for you perhaps would be the very popular technology stocks out there. We've seen the returns that they're getting, but at the same time, there is risk in those. They can fluctuate in value and you have the chance to lose money. It's very different than if you were to invest into a bond or a CD or a money market account. So the theory is investors need to be compensated for taking on that type of additional risk. So let me provide an example, a breakdown of different types of investments and how those risks play in and what those returns would be. So let me share an example from FINRA. Coming in at number 1 at the top, with 10% average annual returns over the long term, are stocks. Stocks have averaged the most over the long term with their return. Coming in second at 6% is corporate bonds, with a 6% annual return annually. Number 3 at a 5.5% average return is treasury bonds over the long term. And last, 3.5% average returns over the long term are treasury bills. So the trade-off is that with higher returns comes greater risk. So of course, as we know, stocks, they are riskier than corporate bonds. And corporate bonds are riskier than treasury bonds because, of course, treasury bonds are backed by the government. And treasury bonds are a little more riskier than treasury bills or bank savings types of products because those are not going to be getting you very much returns. They're more on the conservative side. If we are comfortable taking on more risk for higher returns and we can stomach those ups and downs, the fluctuations, and more importantly, the possibility of losing some or all of your money, you may be considered more of an aggressive investor. On the other hand, if you're a person that gets very uncomfortable with the fact that your money may lose some or all of its value, and you like the notion of maybe having a more risk-averse or steady type of investment that you can see very similar returns over the long term, you'll probably be more of a conservative investor. But please, in the show notes, I have a link to a questionnaire. It's a risk tolerance questionnaire. In fact, I'm going to go over it here in a few minutes on the podcast. But go ahead and take that questionnaire or talk to a financial professional. That could lead you in the right direction. So, what does this mean for me? When you're investing and choosing your portfolio, you have to decide what type of risk are you willing to take, and also too, what's comfortable to you. When you start on this process, start with these 2 questions. Number 1, what's my time horizon? And number 2, what's my risk tolerance? So let me start with time horizon. When you think of time horizon, you need to think about when are you going to start withdrawing money from your account and at what rate? When I say withdraw money, it's more when you're looking to retire. So when do you plan to begin withdrawing money from your investments? Is that going to be in less than 3 years? Is that going to be in 3 to 5 years? 6 to 10 years, 11 years or more? If that date's many years away, you may be more comfortable with a portfolio that carries a greater amount of potential for growth and a high level of risk because guess what? You have more time to weather the inevitable ups and downs in the markets. So if the markets went down here, in the near future, you still have years to go before you decide to withdraw money. So you have time to recover those losses or more time to make those gains depending on whatever it may be. If, on the other hand, you plan to begin withdrawing money and at the same time you plan to take a significant chunk or a good amount of that money out in a less than a 5-year period of span, odds are you should probably be more on the conservative side and have a relatively low risk portfolio. So that would include more of bonds in there, treasury bonds, perhaps treasury bills, maybe a little bit of corporate bonds. So you'd be probably more on the conservative side. How do you know what type of risk tolerance you should be? I'm going to do a quick test with you. Hopefully this test will give you a little bit of perspective as to which type of risk you are. So what I'm going to do is this. And again, for the full version of this questionnaire, view the link provided in the show notes. So I'm going to ask you 5 different questions. For each question, there will be one answer. Each answer will have a corresponding point value attached to it, and I'll share that with you. So after asking you these questions, we're going to tally up your score, and you'll be able to see a ballpark range of what type of risk tolerance you are. Of course, if you want to get a precise and accurate measure, again, I encourage you to take that questionnaire view on the show notes. But this will be able to give you a very good, broad-based idea of what type of risk you probably are at your current stage in life and also to investing. So let's go ahead and get started. Question number 1. How would you describe your knowledge of investments? Would you describe it as A, none, B, limited, C, good, or D, extensive? Go ahead, answer this question to yourself now. If you chose A, none, go ahead and give yourself 0 points. If you chose B, limited, give yourself 2 points. If you chose C, good, give yourself 4 points. And if you chose D, extensive, go ahead and give yourself 6 points. So remember, through these questions, keep track of your points so we can tally them at the end of the test. Question number 2. When you invest your money, are you A, most concerned about your investments losing value, B, equally concerned about your investments losing or gaining value, or C, most concerned about your investments gaining value? So, if you chose A, most concerned about your investments losing value, give yourself 0 points. If you chose B, you're equally concerned about your investments losing or gaining value, give yourself 4 points. And if you chose C, you're most concerned about your investments gaining value, then go ahead and give yourself 8 points. Question number 3. Select the investments you currently own or have owned in the past with the highest number of points. So what I'm going to do is I'm going to go down a list of 4 different investments. And the 4 are going to go from highest to lowest amount of points. Pick the one with the highest corresponding point value. A. If you have owned or own international stocks or funds, if you have investments in Europe or Asia or emerging markets, something along those lines, then you're going to pick A. Give yourself 8 points. B. If you have owned or own stocks or stock funds, so that could be mutual funds, that could be ETFs, exchange traded funds, so those would be called predominantly large cap funds, mid cap funds, small cap funds perhaps in your accounts. You're going to want to pick B. Give yourself 6 points. If you've owned or own bonds or bond funds, most likely you've known if you've owned bonds or not, but if all of you've owned is bonds, you've never wanted to touch stocks or anything like that, then you're going to go ahead and pick C, give yourself 3 points. And if you've owned or own money market funds or cash investments, give yourself 0 points. Question number 4. Consider this scenario. So imagine, in the past 3 months, the overall stock market has lost 25% of its value. An individual investment you own also lost 25% of its value. What would you do? So would you A. Sell all of your shares, B. Sell some of your shares, C. Do nothing, D. Buy more shares? So if you chose A. Sell all of your shares, give yourself 0 points. If you chose B. Sell some of your shares, give yourself 2 points. If you chose C, do nothing, give yourself 5 points. And if you chose D, buy more shares, go ahead and give yourself 8 points. Number 5, last question. So I'm going to share with you the best and worst case annual returns of 5 hypothetical investment plans. which range of possible outcomes is most acceptable to you. So make sure you're honest with yourself. Decide what type of plan would probably be best suitable for you. Plan A. It will give you an average return of 7.2%. So that's on average will give you 7.2%. At the best case, you'll get a 16.3% return. And at the worst case, you'll receive a negative 5.6% return. Plan B. You'll receive an average annual return of 9%. At the best case, you'll receive a 25% return. And at the worst case, you'll receive a negative 12.1% return. Plan C, an average annual return of 10.4%. So with Plan C, you'll receive, on average, a return of 10.4%. At the best case, you'll get a 33.6% return, not too shabby. And at the worst case, you'll receive a negative 18.2% return. Plan D, on average, annual returns of 11.7%. At the best case, you'll get a 42.8% return. And at the worst case, you'll receive a negative 24% return. Or Plan E, an average annual return of 12.5%. At the best case, you'll receive a 50% return. And at the worst case, you'll receive a negative 28.2% return. So go ahead, pick the plan that you think is the best for you. If you need to rewind this and listen to them again, then please go ahead. If you chose Plan A, give yourself 0 points. If you chose Plan B, give yourself 3 points. If you chose Plan C, give yourself 6 points. If you chose Plan D, give yourself 8 points. And if you chose Plan E, go ahead, give yourself 10 points. Great. Now let's tally up your scores. How many points have you scored? Of course, again, to get a precise and accurate score, please view the questionnaire in my show notes link. So let's see what your scores would be. Drum roll. That was a pretty bad drum roll. So, if you scored 0 to 18, you are most likely going to be considered a conservative investor. If you scored 19 to 31 points, you are most likely to be a moderately conservative investor. So you're still conservative but willing to take a little bit of risk. And if you scored between 32 and 40 points, you're most likely either a moderately aggressive, or aggressive investor, depending on your time horizon. So my friends, risk is a very important factor you need to take into consideration when investing. I encourage you to find out what type of risk tolerance you have for investing. Hopefully it'll make your experience with investing more suitable to your needs, and will be a little bit easier for you in the long term. So, thank you so much. I look forward to talking to you soon. Enjoy the rest of your day. Have a great day. Thank you.